Imagine, just for a second, a massive, catastrophic event hitting a major financial hub. We're talking power grids completely failing, communication networks collapsing, physical infrastructure just compromised. In that exact moment, billions of dollars, millions of individual trades, and honestly, the financial stability of an entire nation are hanging by a single thread. So what actually prevents absolute chaos? Well, welcome to this explainer. Today, we are going to unpack the ultimate blueprint for market survival. We're looking at the strict, incredibly high-stakes regulations designed to keep a massive stock exchange running even when the world around it practically stops.
All of these rules stem from a very specific source, the official circular from the Securities and Exchange Board of India, or SEBI, which was issued on March 22, 2021. Now, on the surface, sure, it just looks like a dense wall of standard regulatory text, but when you really peel back the layers, this document is an intense, unyielding mandate. It sets these precise, zero-tolerance rules that guarantee India's market data remains entirely safe, intact, and continuously operational no matter what disaster hits.
To make sense of this, here's our roadmap. First, protecting the financial grid. Second, the three-site strategy. Third, the race against time. Fourth, the human element. Fifth, unannounced stress tests. And finally, the blueprint for survival.
Okay, Section 1. Protecting the financial grid. What is actually at stake here?
Before we get into how they protect the system, we really need to understand the stakes. This circular targets what are known as MIIs, or market infrastructure institutions. We're talking about the massive entities that form the absolute backbone of the financial market. This includes the stock exchanges, where the actual buying and selling happens, the clearing corporations that guarantee all those trades, and the depositories that digitally hold the assets. Look, these institutions process millions of transactions. If their critical systems fail, like trading, risk management, or settlement processes, the entire financial ecosystem effectively just freezes. So how do you protect an infrastructure that simply cannot be allowed to fail? Well, you ensure it physically cannot be taken down by a single event.
That brings us to Section 2, the three-site strategy: location, location, location.
To pull this off, SEBI mandates a strict three-site architecture. Think of it kind of like backing up your most vital computer files, but on an industrial, nation-state scale. First up, we have the primary data center, or PDC. This handles everyday normal operations. Then we have the near site. This one is tied directly to the PDC with synchronous replication to ensure absolutely zero data loss. But here's the real failsafe, the disaster recovery site, or DRS. SEBI mandates that this DRS must be set up in a completely different seismic zone or at least 500 kilometers away from the primary site. The logic is brilliantly simple but absolutely critical. A single natural disaster, like a massive earthquake, cannot physically wipe out both the primary site and the backup site at the same time.
Next up, Section 3, the race against time, the strict countdowns.
Because, having the data safe in a distant location is one thing, but how fast can you actually turn it back on? In a market crisis, indecision and delays literally cost billions. 30 minutes. That is the exact maximum time frame an MII has to officially declare an incident a disaster after a critical system gets disrupted. There is absolutely no waiting around for a few hours, just hoping the IT department can fix a glitch. Within half an hour, leadership must make the massive call to abandon the primary site.
And from the exact moment that disaster is declared, a brand new countdown begins, 45 minutes. This is known as the Recovery Time Objective, or RTO. They have exactly 45 minutes to completely restore all critical operations from the disaster recovery site located hundreds of kilometers away. Just imagine essentially rebooting the entire national stock market in the time it takes to watch a single episode of television.
And then there's the Recovery Point Objective, or RPO, which SEBI mandates is just 15 minutes. This defines the maximum tolerable period for which data might be lost due to a major incident. These incredibly tight margins mean the technology continuously replicating data across the country must be completely flawless, with high availability and no single point of failure. But here's the thing. State-of-the-art infrastructure and ultra-fast cables, they're entirely useless without a highly trained team to run them.
Which leads perfectly into Section 4, the human element. Who pushes the button?
The rules mandate an absolute separation of teams. You've got your primary data center staff handling the daily, high-stress trading operations. But SEBI requires that the manpower deployed at the disaster recovery site must have the exact same level of expertise. They have to know the technological and procedural systems inside and out.
And here is the real kicker. During a crisis, the DRS staff must be able to run live operations completely independently at a moment's notice, without involving the primary staff at all. Basically, if the primary site is underwater, those primary operators aren't exactly going to be available to answer technical support calls, right?
So who actually pushes the button to pull this trigger? Well, SEBI mandates a dedicated incident and response team or crisis management team. And this cannot just be delegated to middle management. It must be chaired directly by the managing director or, in their absence, the chief technology officer. The ultimate responsibility for officially declaring a disaster and shifting the weight of the entire financial market to a backup site sits right at the very top of the executive chain. No passing the buck.
Section 5. Unannounced stress tests. The surprise fire drill.
Because it's really easy to have a recovery plan just sitting in a binder on an executive's desk. But how do you know it actually works? You test it. And CBI's approach isn't your standard scheduled weekend IT maintenance. They mandate surprise fire drills. Every 6 months, the institution must run unannounced, live trading directly from the disaster recovery site. Here's exactly how it goes down. First, the DRS staff is given a mere 45 minutes of notice. Second, during this drill, the primary staff are explicitly prohibited from helping in any manner whatsoever. And third, they must successfully run all operations, including a full live trading day on normal working days, not weekends, entirely from the backup site. This injects incredible real-world tension into the system to ensure the fail-safe isn't just theoretical, but practically invincible. And to consistently pull off 45-minute total system recoveries and pass unannounced live-fire drills, an institution needs a living, breathing rulebook.
Which brings us to our final section, Section 6, the Blueprint for Survival, Policy and Preparedness.
This is the massive administrative engine working behind the scenes, the business continuity plan and disaster recovery policy document. This thing outlines standard operating procedures for exactly what to do during a disaster, clear escalation hierarchies, and comprehensive communication protocols for both internal and external updates. If a technical problem does happen to occur, they are strictly mandated to perform a formal root cause analysis just to prevent it from ever happening again. Furthermore, this policy is constantly monitored. The Technology Committee has to review the implementation of this policy on a quarterly basis, and the entire document is reviewed at least once every 6 months. This ensures the disaster recovery plan never gets stale and actually evolves right alongside technological advancements.
So we've seen exactly how rigorous the standards are for market infrastructure institutions, from mandatory 500-kilometer geographic buffers to those unforgiving 45-minute recovery clocks, right down to the surprise live market fire drills. It is an incredible feat of organizational and technological engineering mandated by this regulatory circular. But it leaves us with a final, really provocative thought. If the stock market is legally required to guarantee total system recovery in 45 minutes across a 500-kilometer gap without relying on its primary team, is the vital digital infrastructure in your own business or even your own life anywhere near as secure? Thank you for joining me on this explainer. I hope this breakdown gave you a deeper appreciation for the invisible safety nets keeping our financial markets alive.